We are just hours away from an all-important US FOMC meeting that may signal a slower pace of rate hikes here on, starting December. But even if it does that, financial conditions are tightening around the world. To parse the impact of this tightening on Asia and on India in particular, I have with me Dr. Krishna Srinivasan, who is the director of the Asia and Pacific departments at the IMF. Dr. Krishna, let me first apprise our viewers of the IMF's latest outlook, the one that you also spoke about in Delhi. The fund recently downgraded global economic growth and that of most large countries and regions. It now sees global growth at 3.2% this year, 2022, and only 2.7% in 2023 next year, which will be the slowest in 20 years if you exclude the COVID year. In addition, the fund has cut the growth forecast for Asia as well by about 80 to 90 basis points for this year and next. The fund sees India's growth at 6.8% in the current year and at 6.1% next year. Now, with this preface, let me invite our guest, Dr. Krishna Srinivasan. Dr. Srinivasan, thank you very much for sparing time. First up, there is this meeting upon us, and so I wanted to ask you, even assuming that it is 75 basis November, 50 basis December, as the dot plot indicates, and another 25 or 50 coming in early 23, it is still nearly 5%. Do you think that this can be inimical even to Asia, where inflation is not so high?
Thanks, Ada. It's good to be here. Again, if you look at a World Economic Outlook, which we published in October, we have the Fed funds rate at 4.5% in early 2023. Now, what this means is that financial conditions for Asia, for countries in Asia, are going to tighten further. And, in many ways, central banks in Asia will likely have to respond by tightening here too. So you're going to see both an increase in dollar funding costs and in local borrowing costs. So financial conditions are going to tighten, will likely tighten for all of Asia, which means that there are risks of growth. And so we make some of these assumptions in our forecast, and but we also make the point very clear that downside risks are significant. And so growth in Asia, while at 4% for this year and 4.3% for next year, is subject to downside risks.
Okay. Well, Dr. Srinivasan, why I ask you is that there is an ongoing debate in India that we have done better with our macros. We did not splurge in terms of fiscal spend, and our inflation is not as bad. I mean, at 6 to 7%, yes, we are 2 percentage points above our target, but not like it is in the West, where it's a huge gap. Therefore, the debate here is: does India need to hike in step with the Fed at all?
So Lata, let me just add a couple of observations here. Some of the work we have done tells us two things. One, that core inflation, right? That inflation is brought into core inflation beyond headline inflation. Number two, that core inflation we find is a lot more persistent. And number three, what we find is that the pass-through from depreciation to inflation is going to be higher than what it was in the past. So for all three reasons, we think inflation is still going to be a concern for all of Asia, including India. And so the monetary tightening needs to stay its course.
There's another academic debate in which I want to draw you in. The Indian MPC, it's a young body. We constituted it only in 2016. And their given mandate is obviously domestic inflation. But the Reserve Bank, being Reserve Bank, for them inflation is one big prominent concern. But they have to look at financial stability, external stability. And therefore, the Reserve Bank perhaps would like to keep tightening because of the possible attack on the rupee. But external MPC members will stick to their mandate of domestic inflation. Do you think rate hikes are warranted merely to be a bastion for the rupee?
So what you're going to see is that, at a time when, look at what's happening to the exchange rate. It's basically the depreciation of the rupee, and in fact of all currencies in Asia and elsewhere, is being driven by two things. One is the terms of trade shock, which we saw when there was a war in Ukraine began in February, and following that, a lot of exchange rate movements are being explained by the interest rate differentials. To the extent that these differentials widen, you're going to see more pressure on exchange rate. And so in one way or the other, central banks will feel the pressure to tighten. And I agree that there is an issue of trade-off between growth and inflation, but we worry that if you don't address inflation head-on, the impact of that could be significantly worse down the road. So you're better off addressing inflation head-on now, so that you anchor inflation expectations, you don't get unanchored, and so that you have more stability in that sense. If you don't tighten now, runaway inflation could be a problem. I'm here again. I'm not just talking of India. I'm talking of countries in Asia and elsewhere.
Well, actually, speaking of that, the report, the regional economic report that you said, has, of course, only a few paragraphs for India. It deals with all the Asian and Pacific countries that are within your department. But what is your pecking order, and where does India figure at all in terms of relative resilience?
So again, compared to other countries in the region, again, let me put things in perspective. Asia is going at 4% and 4.3% next year. Let's take an average of 4%. That is significantly lower than the 5.5% average growth for Asia, right? So compared to that, India at 6.8% this year and 6.1% next year is a relative bright spot. And, our reserve position is good. Things look much different in terms of macro fundamentals relative to, say, the taper tantrum episode. However, there are issues we have to worry about, right? Still the fact that debt levels are high at 84% of GDP, now are about that amount. So there are these worrying macro, which need to, there's a sense of caution which needs to be brought into the picture here. So yes, the headline growth numbers are better than for many other countries. Again, they are subject to downside risks. And given all the heightened uncertainty going forward, one has to be cautious in terms of policy formulation.
You are saying that our 6.1% also is subject to downside risk?
Yes, yes. Because,
actually, let me elaborate on that. We've got RBI sitting at 6.2, which is a very, very preliminary forecast they give. They will refine it in subsequent MPRs, monetary policy reports. But the initial estimate is 6.2 for FY24. Most of the economists I have met are sitting slightly south of 6. IMF is at 6.1. Economists are between 5.8, 5.9, even lower, some of them. Dr. Anant Nageshwaran put up a spirited fight when you spoke in Delhi. He said he expects upside surprises to 6.1 because we could be at the start of a capex cycle. You're not buying that?
So, see, our projections are underpinned by two things. One is that the capex cycle will continue, and that consumption will also be reasonably robust, right? So, but the question is, given the fact that interest rates are rising, the question is how much of capex is going to materialize. So that's one question. So that's what I say, that 6.1% is our baseline forecast. There are downside risks, not just domestic, but also external. External headwinds are rising. And so one has to take both the external headwinds along with domestic compulsions if interest rates continue to rise. And so that's why we say 6.1%, but downside risks.
Okay, I guess a lot of people on the street are believing that downside risk. You spoke about external environment as one big reason why you would put that downside risk. The way the stock markets are behaving, now that inflation appears to have peaked in the US and the Fed's, excessive tightening, front loading is over, and it will probably move down to 50 basis probably in the next meeting. There is actually a sigh of relief, and we are seeing a risk-on rally. Do you think that this kind of euphoria could be short-lived, and very soon we are going to see the impact of that 4% Fed funds rate or 4.5% Fed funds rate? Will we worry much more about growth slowdown next year?
I think so. I think clearly, we have. If you look at our numbers for the US for next year, it's very much, it's at 1%, right? For 2023, it's 1.6% this year, 1% next year. For the euro area, similarly, a sharp slowdown. And why is that? Because the rates have increased quite significantly across the thing. And so, if I had to give you one thing, I would say countries accounting for 30% of global output will be in some kind of a recession. They'll feel like recession. So it is coming, the slowdown is coming. And in many ways, 2023 could be worse than 2022. So one has to have a sense of caution here. And also, let's not forget that across the board, especially in Asia, the fiscal space is quite limited. So how are you going to, support the economy? So those are issues which we need to take into account when you talk about euphoria or the lack, or too much euphoria versus more realism.
Okay. Well, let me then, I have a few more minutes with you, so let me use that to get your view on the medium-term India story. If we are looking beyond 2023,
Yeah.
The expectation is that, our fertility rate now is down to 1. This is the period of our demographic dividend. It may be much lower than what we would like it to be because of our literacy and health, perhaps lack of achievements. But still, it is there. It is a demographic, demographic dividend decade. And plus, I think, doing extremely well on digitalization, which is reducing leakages and probably empowering more people. Anyway, my point is there enough raw material to be bullish? To expect 7% our aspirational growth beyond 24?
Beyond 24, I think our estimates of potential growth is at about 6%.
Oh.
Okay, and that takes into account two factors. We had even before the pre-pandemic, we had some issues there with we had the financial the NBFC's shock there, and then now we have the pandemic, where significant losses have risen. In fact, if you look at our regional economic outlook, the losses are quite significant, and they can be traced to three things: investment, labor, and productivity. Again, the question there is, it differs from country to country, but 6% is still a slowdown. I mean, compared to the past, right? So the question is, what can you do about it? And I think here there are reforms which can be, taken into account. If you facilitate business creation by, say, land reforms, or if you talk in terms of spurring productivity by having labor market reforms at the state level, or you talk of catching up with education losses again. And finally, if you harness digitalization, there could be an upside to it. But one has to take into account the fact that the pandemic led to some losses which need to be recouped. So a sense of realism. We are at 6% for the medium term beyond 2024.
Okay, it's not a very good number, but yes, it's entirely in our hands. Nothing is inevitable. Political will can change a lot. Thank you very much, Dr. Srinivasan, for speaking to us. I would have loved if we could speak to you after the FOMC meeting when the global terrain would be much clearer. So I'll take a rain check from you for another meeting. Thank you very much indeed for joining us.
Thank you.
Okay, well, that's the backdrop in which we will head into. Some things will change with the FOMC meeting, but a lot will continue in terms of core inflation worries, currency worries, current account deficit worries, fiscal deficit worries, etc. And that's what Dr. Srinivasan is pointing to. Wrap up on Bazaar on the note that the markets are extremely flat, but a bit of positivity in the mid-cap.